Studies have shown that the average person stinks at investing. A recent study by Dalbar Quantitative Analysis of Investment Behavior found that while the S&P 500 produced a 9.65% annualized total return in the 30-year period through the end of 2022, the average equity fund investor only managed to see a 6.81% return. This 2.84% annual shortfall, extrapolated over a 30-year investing window, means that the average investor's portfolio was about 60% smaller than it could have been had they simply invested in the S&P 500 and done nothing else. The three leading causes for this discrepancy in returns are emotional investing, overtrading, and not paying attention to fees. When the stock market is booming and you hear your friends and colleagues boasting about their returns, you are more likely to plow more money into the market yourself to not miss out. Conversely, when the market is dropping, you are more likely to sell out of the market and preserve your cash. This cycle of chasing the market typically results in missed opportunities that compound over time. Another factor that leads to poor results is shifting your investments too often because Fund A is performing better than Fund B. This is just another form of chasing returns, rather than staying put and allowing long-term investing to work for you. The final straw is not paying attention to the fees you're paying on the investments you own. Passively managed index funds typically charge very low fees, but actively managed funds that charge heftier fees lure investors with promises of better returns. However, over the long term, these funds rarely deliver on these promises. And just like investment returns compound over time, paying higher fees eats away at your capital faster each year. Of course, not all average investors underperform the S&P 500. Some have managed to outperform the index, and perhaps a handful have done so by a wide margin. Legendary investors like Warren Buffett, Terry Smith, and Howard Marks are proof that beating the market is possible, and it can be done consistently for decades. These three gentlemen, and countless others, follow a simple strategy of investing in high-quality businesses, buying them at a fair price, and holding on to these companies for a long time. These investors have dedicated their lives to the pursuit of perfecting their investing acumen, but perhaps the same is not possible for the average investor, who can only commit an hour or two each week to refine their strategy. But what if I told you we could replicate an investing strategy focused on high-quality companies trading for reasonable valuations, with rules-based investing rather than finding investment opportunities one at a time? I'd like to tell you about a rules-based investing strategy I am working on right now. The full process is documented in my free newsletter, Quality at a Fair Price. There's a link in the description below. The premise of this exercise is based on answering two questions. How can we identify high-quality companies? And how can we measure if they are attractively valued? Well, what we need to do is screen for companies that have certain characteristics that, in my opinion, define them as high-quality businesses. The characteristics I chose to review are dividend growth, the return on invested capital, the return on capital employed, the return on equity, the return on assets, the free cash flow margin, the gross profit margin, the diluted earnings per share growth rate, and the revenue growth rate. To narrow down the test universe of stocks for me to analyze, I screened the market for the following 5 conditions. The company must trade on the New York Stock Exchange or the Nasdaq. It must have a 5-year dividend growth rate of at least 5%. It must have a 5-year return on capital employed of at least 15%. It must have a 5-year average gross margin of at least 20%. And it must have a 5-year revenue growth rate of at least 5%. This screener gave me 141 unique companies to review. I further trimmed this list down to 111 companies, mainly due to missing data points. I reviewed the value each company had for each of the original 9 financial metrics, and I compared its compounded annual growth rate relative to the entire universe to see if I could find any patterns. Generally, companies that had higher values for each metric also had better rates of return. The next step was to see how many companies had higher than median values for each of the 9 financial metrics, and to see if there was any correlation between these companies and overall rates of return. In the 5-year analysis, only 4 companies were better than median across all 9 metrics. 8 companies were better than median in 8 out of the 9 metrics, and the number of companies that were better than median continued to increase as I lowered the threshold. The final counts shaped an almost ideal bell curve, with the highest number of companies exceeding their peers in 4 or 5 out of the 9 metrics, and the count of companies shrunk the further we moved out, up or down the spectrum. What was interesting, though, was that the average compounded annual growth rate formed a linear upward path. Companies that were not better than median for any of the 9 metrics, on average, had the worst CAGR. And as the count of better than median metrics increased, so too did the average CAGR, with the 4 companies that were better than average across all 9 metrics seeing the best average CAGR of all. This was interesting, but if you think about it, it's an almost backwards way to look at the problem. Clearly, companies that had the best returns on invested capital, or equity, or assets, or any of the other metrics I tested during the past 5 years should have also seen the best average returns. Companies that are able to grow faster should deliver better returns to shareholders. However, this analysis wasn't done unintentionally. What it allowed me to do is try to figure out which of these 9 metrics, if any, was more correlated with the compounded annual growth rate. Part 2 of the process involved looking at each metric individually in order to find out which ones are more useful. For this, I tested the average CAGR of the companies that were better than median for each metric. The best metric turned out to be the earnings per share growth rate. The second best metric was the return on invested capital, then the return on capital employed, then the return on assets, then the dividend growth rate, the revenue growth rate, the return on equity, with the free cash flow margin and gross margin being the worst. The order of these metrics is important, as it will help me test which combination of these metrics leads to the best overall model. I designed a simple model and included each of these metrics one at a time and reviewed how it changed the CAGR. If adding a specific metric improved the return of the model, it was left in, and if it didn't, that metric was eliminated. I went through numerous iterations that are all summarized in the newsletter, but the 2 models that turned out to be the best were, including the earnings per share growth rate, return on invested capital, return on capital employed, and the dividend growth rate, that resulted in a CAGR of 33.4%, and the same model plus the revenue growth rate that resulted in a CAGR of 33.15%. The other metrics were scrapped, and it was time to actually backtest this model portfolio. Gathering the data took a long time because I needed to go back all the way to 2014 and find the value of each of these 5 metrics for 111 companies. After the data was gathered, I designed and tested 6 model portfolios, of which all 6 outperformed the S&P 500, and 5 out of the 6 outperformed the investable universe made up of all 111 companies. If you want to see the details of each model portfolio, you can check them out in part 2 of this series in the newsletter. I'm going to skip ahead to part 3 that takes this strategy one step further. The original 6 model portfolios all focused on finding high-quality companies. Their outperformance relative to the S&P 500 ranged from 6 to nearly 12% in terms of the annual CAGR. However, their outperformance relative to the investable universe was not that great. One strategy failed to beat the universe, while the other 5 ranged from less than 0.5% to a high of 4% of annual outperformance. While 4% of annual outperformance can compound to a significantly higher dollar amount over a long enough period of time, I thought we could do better. That is why I decided it was prudent that I test if adding a valuation metric to these strategies would yield any improvement. The valuation metric I chose to test is the free cash flow yield, that measures the amount of cash generated from core operations relative to the valuation of the company. Basically, companies with higher free cash flow yields are more attractive than companies with lower free cash flow yields. So I took the original 6 model portfolios, and I built 6 new portfolios that all included the free cash flow yield as a factor in the stock selection process. The outcome was favorable, as each of the new model portfolios showed an improvement in the CAGR ranging between 3 to 6%, above the best of the original 6 model portfolios. The model that I like the most is model number 7, that resulted in a final CAGR of 33.53%, which was 17.01% of alpha over the S&P 500, and 9.01% of alpha over the investable universe. This model had really good returns during each tested year, beating the S&P 500 in every single year, and only once marginally trailing the investable universe. This will likely be the model portfolio that I will use to launch the actual portfolio that will test the strategy going forward next month. There's a few more things I need to work out before we can launch the portfolio, but it will highly likely go live on May 1st. The portfolio will consist of the top 20 stocks identified by this strategy. These stocks will be held at an equal weight of 5% for a full year. Then next year, at the end of April, I will run the screening process again and rebalance the portfolio as necessary. I would like to see this strategy generate alpha over the S&P 500 and the investable universe in the long run. It may underperform during certain months, perhaps even have losing years, but I believe it can deliver on my expectations during the next decade. If you want to know more about this strategy, you can check out the 3 parts of this series in my free newsletter. If you want to see the actual portfolio before it's launched, or keep up with how it performs in the future, you can subscribe to the newsletter to have it delivered to your email weekly. I am not advocating for anyone to follow this strategy. Like any other part of investing, there is a level of risk involved here. Just because this strategy worked out well in the backtest does not mean it will work well in the future. Also, this is a very growth-oriented strategy that will likely see higher volatility than the market as a whole. Hopefully you enjoyed this content. If you did, please do me a huge favor. Give this video a like and subscribe to the channel. Thank you for watching and see you next time.